presentation contains current opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello everyone and welcome to the Compak Asset Management Q3 2021 Market Update and Webinar. I'm Moe Ansari, President of Compak Asset Management and host of Market Wrap. Thank you for tuning in. Again, if you have questions today, you can ask all the questions. All you have to do is go to the chat feature, type them in, and I'm going to try to get to as many of them as I can. I'm going to talk a lot about different things today. I'm going to start with the risk and reality of inflation, how that could impact the markets. Everybody was talking about inflation and it's coming about a month and a half ago. It was the biggest story. Jay Powell was saying it's transitory. He's the chairman of the Federal Reserve. But now people are forgetting about inflation, saying, oh, we might not have the growth that everybody's expecting. So we are in the summer doldrums, as I talked about a couple of months ago when I did the last webinar, that we are going to get into these summer doldrums. But where are we going to go from here? That is the question I'm going to try and answer for you. We're going to talk about the deficits and debt. Can we keep spending at the rate we are, the U.S. government, without running into problems? What about the stock market? Can the stock market rally continue? Will international and emerging markets rebound? Let's talk a little bit about that today in detail. Fixed income analysis, why the yields are negative in the European Union. Will current inflation lead to significant rise in interest rates? That's what everybody said. We're going to see a spike in inflation. We're going to see 70s-style inflation. Consequently, we could see 70s-style interest rates. Will that happen? I'll try and answer that also. What about the Biden agenda? Will the stepped-up basis go away? If you don't know what stepped-up basis is, it is a big, big deal. And we'll talk about taxes. Will they rise significantly? And what will be the impact if the taxes do go up on earnings for companies? That's really what we are concerned about, is how will this impact the earnings? And what does that do to the stock market? Crypto, is it real or is it a bubble? Has it burst already? Try to answer that question. And the post-pandemic world, 5-day on-site work week. Are we going back to work 5 days a week? I don't think so. We'll talk about that also. What is the impact on sectors and technology? So a lot to talk about. Let's start with the debt and deficits. And are we about to see a disruptive spike in interest rates? That's the biggest question in inflation. Are we going to see 70s-style inflation? Let's get into in depth a little bit and talk about this. But before I do that, I will be in San Jose on next week. If you want to meet with me, you have an opportunity. I will sit down with you. I'll devise a plan for you specifically, and we will find a solution to get you from where you are now to where you want to go. I will go directly from San Jose to Scottsdale, Arizona. I know I'm getting out and about, and it's fun to see everybody all and put some faces behind all the voices, all the people that I talk to, and sit down with you. So I will be in Scottsdale on the 4th and the 5th. If you would like to meet, you can just head to compak.com or contact your relationship manager, the person that you talked to that invited you to the webinar, to the seminar, to all of these events that we are doing across the country. You can just go ahead and call them or go to compak.com and register, and I'll sit down with you and we'll develop a plan for you. The inflation, yes, it is the blue line right here. You can see that is the headline inflation. The average rate is about 4% is what we've seen. And we are spiking above that. We had seen the spike in 2008 also, but as the recession hit, inflation came right back down. Now we've seen inflation hit a low, but it's starting to come back up. I think this is a transitory situation where we had so much pent-up demand, where so many people were sitting around and just not able to do anything. And all of a sudden, once we got the vaccine, we're out there and everybody wants to go everywhere that they can where there are enough people have been vaccinated. That's really the key. We are seeing another surge, but that is a surge, that is the virus of the unvaccinated, and I don't think it'll have any big impact. We're not going to go into a lockdown. That's the biggest thing. It will not economically affect us. Yes, unfortunately, there are a lot of people that are ending up in the hospitals again, but 97.5% of those people are unvaccinated. That's a choice they've made, so we can't do anything about that. But I think the biggest thing that it will do will not have a big impact on the economy, because we are not going to lock down again. Yes, we could have some mask mandates. Some people will be a little bit more hesitant from traveling, but I think we are still, now we are out, we're not going back to the lockdown stage. You look at the consumer price index, going back to that, used cars and trucks are the ones that are really spiked up. They've started to come back down a little bit. Most of this has been due to the shortage of chips. That is, the semiconductor chips that go into cars. They just don't go into computers, but they also go into automobiles. Once you get them into automobiles, that's where the demand has been. Last year, all the automakers canceled all their orders. Consequently, all the chip makers didn't make all the chips. Now, as everybody opened, everybody wanted to get cars. The chips are not there, and that is what is causing the shortage of new cars. Consequently, people are buying used cars, and the price of used cars have gone up. I think, again, this is a temporary phenomena. I think in the next couple of months, we're going to get a lot of these chips back. We'll see production come back online in new cars, and that'll bring prices down. But that has been a big component in the spike in inflation. Food items, you can see that transportation services have gone up, but food items are pretty much right where they are. A big thing that we have seen is this pent-up demand is the savings rate. If you go back to about 15 years or so, the savings rate was about 4%. This is where we were. Then we had jumped up to about 8 during recession. This is the recession of 2008 and 9. People get nervous, people don't spend, people try to save because we're not sure of what's going to happen to the economy. That's when the rates go up. We hit about 8-9%, but after the recession, we came back down. Then again, we had a little bit of a scare in 2012-13. We got up above 10% for savings rate. But then we sort of stabilized along here at about 8% was the savings rate. That's where we were. All of a sudden, in this recession, the savings rate have gone up to nearly 35%, which is an incredible amount of savings. But it's not just savings, it's just we did not have the opportunity to spend the money. So people now are saying, okay, as soon as they got out, they started to spend this money. The savings rates are coming down. Spiked again when we had the second wave but now we're coming back down again. And that's, I think this savings rate is going to come back to normal, but we have this tremendous amount of savings sitting in the banks. It's not just individuals. Corporations did the same thing. Everybody saved cash because they thought we were going to go into something of a structural recession, but we didn't. We had what is called a event-driven recession, which lasted only 2 to 3 months. So I think we are looking at labor costs also that have gone up dramatically, but a lot of that has been due to the labor 300 extra unemployment. If you pay people are making more money sitting at home than they would be going to work. It doesn't make sense for them to go to work. But the 300 extra unemployment, it ends in September. Some states have already ended it. So those states, if you see the unemployment rates in those states have already come down. So the COVID supply, disruption of supply chains, I think they're going to adjust. They are adjusting. We saw lumber prices spike. They came right back down once the lumber producers started producing the lumber. We have pent-up demand. They're tired of people, but looking for opportunity to spend the money. As we go through this and kids get back to school in September, I believe we're going to fall into a normal rhythm. Or what I mean by that, go back to a pre-COVID sort of a routine. Kids will be back in school. We've done the summer vacations, done everything we wanted to do, and I think we still have accumulated savings rate and consumer liquidity, and that's at the very, very high level. I think that's going to revert to the mean, come back down. Low base of inflation. Also, the inflation numbers we've seen have been very high lately. But when we are looking at this inflation as compared to last year, we say, well, inflation is up this much from the same time last year. Well, the same time last year, we were locked in our homes. We had COVID, and no one was going anywhere. With that situation, I think those comparisons are such a low bar that this year when we get inflation, if we have a low bar of 1 and it goes to all of a sudden goes to 2, we say, oh my God, that's a 100% increase. But if you have 100 and it goes to 101, that's only a 1% increase. So that's why I think the numbers that we're looking at now we're not comparing them to reality, which is last year. I think once we get past this sort of bulge in inflation, which is this comparison, and we see more normal comparisons coming next year, that'll bring the inflation rate down also. Hot inflation, I think it's going to run until January 2022. That's what I'm looking for. And then we could get 3.5 to 4. Then I think we're going to revert to about 2.25 to about in somewhere around 2022. So that's the inflation picture. It is what I believe transitory. As Jay Powell, that's the famous word, as I say, if you've been listening to the radio broadcast, I've talked a lot about that. I believe it's transitory. It's a short-term bulge, short-term spike in demand, and as this demand subsides, so will the inflation. As the demand, we get into a normal rhythm of life, I think so will the huge spike. We also saw unemployment rates get up to 14%. They're back down to 5.9. Again, a lot of this is due to, I believe, the extra wages that people are getting, where they're getting more money from the government than working. And if you look at this is the pandemic emergency unemployment compensation, and this is the pandemic unemployment assistance. That is the orange, and that is the red. If you take that out, we just look at the regular employment, which is in blue, you will see that it's fairly close to March of 2019, not 2020, but March of 2020, which is prior to the pandemic. So if we get rid of all of this, we get back down to this, which I believe in the next 3 or 4 weeks, we are going to get back to that. As people realize that those extra benefits are going away, they're going to start looking for jobs, and consequently the job unemployment rate, we feel, is going to continue to come down. The biggest rate increase we're seeing is in leisure and hospitality. That's where people work face-to-face, and the leisure industry. The leisure industry has come back, but again, nobody's traveling internationally. We still have problems in Europe where the bungled vaccine rollout, and now when they have some very high cases of COVID, even in the vaccinated, we're seeing breakthrough infections because most of the people there took the AstraZeneca or the Johnson & Johnson, and the efficacy of those vaccines is a lot different than the mRNA vaccines, which are the Pfizer and the Moderna vaccine. You look at people who want to say they will need much higher wages. This is the dark blue line. That is people who make less than $60,000. They want a lot more money to come back to work. People who make more than $60,000 are saying, no, we're okay. We're happy where we are. We're happy with our jobs. Again, people who make less than $60,000 are usually people who are getting these extra unemployment benefits, and once they go away, we feel this line is going to come back down, just like the light blue line has come already down to the downside. One of the things that I look about inflation, and I talk a lot about this, is the velocity of money. That is at the rate at which money is circulating. If you have a whole bunch of money and it's just sitting in your garage, it doesn't cause inflation. If you have a whole bunch of money and you throw down the street and there's people running around, everybody wants a piece of it, lots of people get it, they get out and they go out and spend it, and the next person goes out and spend it, the business gets it, the business buys a new building, new equipment. That is the velocity, the turnover of money. I watch this very carefully, and this is an interesting chart right here. It shows that the velocity of money continues to go down. This is the Federal Reserve balance sheet. It's expanded in 2008, went from about $800 billion to about where it is now. This is about $2 trillion, or about $8 trillion now. That's where we are. It expanded dramatically during 2008 and 9, continued to go up, then it stabilized, and they started to bring it down a little bit. This is what the tapering was. We were going through tapering, and then COVID hit, and we exploded the balance sheet back to the upside. But the money, velocity of money, has not gone up. That means the rate at which it is being turned over in the economy has not gone up. That is one of the things that you want to watch very carefully and is one of the best precursors for inflation. So all the people running around, oh my God, inflation is going to come. As I said 2 or 3 months ago, I don't think so. I think it's going to be transitory. Once we get past the spike, past the bulge in demand, past the problems, supply chain problems, once we smooth all of that out, I think inflation is going to start coming back down. It will take time, probably until the end of this year before we do that. How about the money we're spending? People always call me and say, Mo, we're spending so much money. It's not going to work. We are going to get buried in this debt and deficit. Well, over the last decade and a half, you've heard me talk about it on the radio. I always say that you can't print prosperity. But if you are the richest country in the world, or you're very, very wealthy, the banks give you a big credit limit, so you can spend a lot on your credit cards. Some point you'll hit a limit, but if you're very wealthy, guess what? You have a very large limit. We are one of the wealthiest in the world. One of the biggest borrowing we're doing is about $3.4 trillion we're borrowing. Half of the money we're spending, we're borrowing right now. But a lot of that, 29%, is this pandemic relief stuff. Yeah, we need defense spending, which is about 11%, Social Security 17%, Medicare about 20%, but the other spending, a lot of it is this emergency relief spending. It's going to go away. It's not something that's permanent. We feel that the deficits are going to start coming. They've gone up a lot, accumulated debt, and it's going to stabilize here. Then it starts to go up again. Same thing with the budget surplus forecast. We had a huge deficit. Those deficits, just like we did in 2008 and 9, we had a large deficit. It came down. We're seeing the same thing now. I believe that the deficits are going to come down, even if we get an infrastructure bill. I'll talk about that. I think we could get $1 trillion of infrastructure spend, but all of that is not going into people's checking accounts. It will be spread over 8 to 10 years. So it's about 100 to maybe 200 billion a year, and it goes into roads, into companies that have to go out and build these roads and bridges and all the infrastructure. It does not go directly into people's checking accounts. So that is going to be different. And I believe that is not going to be all of it coming, and it's not going to be as inflationary as direct payments to people. We are the reserve currency of the world. Our economy is $20 trillion. We have the largest defense spending. We spend about $750 billion. Why do I bring that up? Because wherever you keep your money, you want it to be in the safest place. You want it to be in a strong place. Well, the United States spends more money, and we are the strongest country in the world. The dollar can be used to buy U.S. assets. You can bring in money here to the United States, which everybody does whenever they make money anywhere in the world. They bring it all to the United States. They want to buy real estate in the United States. They want to buy stocks in the United States. They want to buy U.S. bonds because we have the rule of law. You have property rights, and that is, we have a very efficient legal system. You have rights. Nobody can come to you and say, look, I like your house, please get out. I won't, not even please, just get out. It does happen in other parts of the world, but not here in the United States. We have a long tradition of democracy. We still have the people make the decision. Leadership, and we control the IMF, the World Bank, NATO, and China is saying that, look, they're going to set up their own institutions with their own rules. And that, I believe, is going to be the biggest issue. Just like a couple of years ago, I said the biggest is going to be the trade war with China. But now it's becoming more of a global competition for power, for supremacy, for everything else. Is it going to be one of those, or are they going to, the Chinese and the United States, work together? Are the Chinese going to say, we are going to live with the rules that have been set up? Or we're not going to live by the rules, we are going to make our own rules. That's going to be the biggest conflict over the next 5 to 10 years, which is going to determine where the world goes economically. That, I believe, is a long-term issue, not a short-term issue. Right now, Taiwan will become an issue somewhere down the road, but it's not a short-term issue, it's a long-term issue. China is busy just digesting Hong Kong, which it just took over and suspended all the rules that they had agreed to with the Brits before the Brits left. So that's going to be another, but the Chinese are going to try and set up their own world order, or are they going to live with the existing world order? And what are the other economies going to do? Are they going to go with China, or are they going to side with us in the United States? We can't go alone. But if Europe, Japan, South Korea, majority of Asia, decides to go with the United States and say, this is the system we like. We don't like we like democracy. We don't want autocracy where Xi Jinping is making all the Communist Party runs your life. People, their narrative is they have a better system. Look at all the chaos. Democracy is messy. When you give so many people so many rights, everybody wants to do their own thing. In China, you don't have rights. You come out of your house, you are being surveyed because somebody's watching you on a camera. And that is the difference. And I believe in the long term, because of the flexibility of the system of democracy, it is going to be, it has been, and will continue to be the best system in the world. These other systems, the autocracies, they are saying, hey, look, we say everybody to march in one particular direction. Anybody out of line, yes, we take them in for re-education. That's what they call it. They put you in jail. But that's, I believe it's such a brittle system. Over a period of time, it's not going to work. So we have the advantage of being the reserve currency of the world. We can borrow as much as everyone else is also borrowing. You look at what's going on in Europe, they're printing money. You look at China, they've been doing it for 20 years. They're building airports that no one flies into. They're building bridges to nowhere. They're building cities that are empty. But that's what they said about the highway system that we built in the 40s right after, and the 50s after the World War. Who's going to drive on these huge roads? Nobody wants them. Now you just want a little bit more road so you can get from point A to point B. China has built the infrastructure over the last 20 years and spent a tremendous amount of money doing so. We have now the opportunity to do it. And so I think everybody else has borrowed already. We are just starting on this. We have controlled inflation. And we have very significant borrowing capacity. We are the richest country in the world. I mean, Greece, which has been going broke for 10 years, can't go broke yet. Their interest rate on their 10-year note is 0.69. Our interest rate on our 10-year note is 1.220 today. Do you want a Greek bond or do you want a U.S. bond? I would like to have something backed by the full credit of the U.S. government, not the Greek government. Long-term outcome depends on alliances, geopolitics, I talked about that, and government policies. That's really how sustainable, but I think we've got 20, 30, 40, 50 years that we can spend before we get to a point where the debt will become a problem. You look at Japan, its percentage of you look at it, they're spending about 214. We are down here. So there's a lot of countries that have to go broke before we do. Let's talk a little bit about the stock market. Can the rally continue? That's the big question. And will the emerging markets catch up? I've said that. I believe that this recovery that we're seeing around the world is going to ricochet around the world. We were the first. Chinese were the first because they came out of COVID faster than anybody else. Then we, because we have the vaccines. In Europe, is going to come out sooner or later. They bungled the initial vaccinations, but now they're getting more and more people vaccinated. Yes, they do have a problem with COVID, especially in the UK, where 80-some% of the infections they're seeing are the Delta variant. We're seeing 97.5% of the people ending up in the hospitals are unvaccinated. So, but again, they are not having the fatality rates. People are not dying. People who've been vaccinated are not dying of COVID anymore. Yes, you do get sick. It might be 2 or 3 days. It's like the flu, and you're fine. That's what we're seeing overall. You look at the valuations. Most of the countries are way above. This is the average 25-year valuation. You can see the average is right here, and this is where we are. This is the average in the emerging markets. This is where we are. The only one below the average is Japan, which has been sort of stuck here for the last 10, 20 years or so. But if you look at the valuation of Great Britain, or the world index versus the S&P, it is about 30% undervalued It's at the lowest valuation compared to the S&P in about 20 years. That means that the international markets are much cheaper than the United States by about 28%, 27.3%. So they're undervalued. We feel as this recovery catches up, they have a lot more to go. That's why you've seen we are looking to increase our portfolios in the international markets. Again, if you have questions, feel free to just type those in, and I will try to get to as many of those as I can. Just go to the question and answer section on your Zoom, and you can type those in, and I'll try to get to as many of those as I can. Looking at the stock market, we have a huge savings flowing into equities. I talked about the savings rate. I've talked about this for a decade. In 2008 and 9, you heard me say when the government prints money, it goes to two places, either the stock market or the real estate market. I said that a decade ago. We're seeing the same outcome this time around. We're seeing it go to the stock market and the real estate market. Both are nearly at all-time highs. Low interest rates, well, historically you could say, well, I've got a choice. I can put my money in a bond, get 5 or 6%, or I can put it in a stock market, maybe get 8 or 10. But do I want to risk the extra 2 or 3 or 4%? Makes a big difference when you compound it over a period of time. But some people said, look, I'm retired, I'm happy, I'm going to get the 5, 6% on my bonds. But there's no bonds that are going to give you 5, 6, 7% at this time. So you have to really look at stocks in lieu of bonds. And historically, if you get 5 or 6, and you look at valuations, they were 16 or 17 PE. But now that the interest rates are so much lower, you have to revalue the stock market because there are very few alternatives. We've got stimulus flowing into asset classes. We are getting some bubbles like crypto and NFT and these meme stocks. But those are isolated incidents. Those are people who are going to go through, they were the people who are chasing the dot-coms. They're all dot-gons at this point. Same thing with crypto and meme stocks and the NFTs. Some of them are going to be okay, and I'll talk about crypto a little bit later on. And we are still looking at another additional maybe $1 trillion in infrastructure plus $3.5 trillion that the president wants with the new social spending infrastructure, or social infrastructure as you call it. I don't think he'll get a lot of this. He might get some of this $1 trillion that he's looking for, which the Democrats and the Republicans are trying to hammer out a deal at this point. So I think equities still offer a reasonable risk return at this point. But they are going to be much more volatile. Once we get to next year, I see volatility going up a lot more, because then the market will be higher than where it is right now. But the question is, where do we get there? When does the correction happen? When do we get another recession? Who knows? You have to enjoy the market, and right now there's a lot more money flowing into this country, and that is going to really, I think, over a period of time, support the market. Showing the ratio of Fed balance sheet to the S&P. Thanks. No charts, but how does that's a great question. There's a question from Sean. He says, Mo, do you have a chart showing the Fed ratio of Fed balance sheet to S&P? I'm sure it's going up. As the balance sheet goes up, so does the S&P. They're directly related. And that's an interesting chart that I don't have one, but I think I'll have some of the research people pull one up, and I'll talk about that. Great question, Sean. Again, if you have questions, you can always just type them into the section on Q&A, and I'll try to get to as many of those as I can. Let me talk about what we do as far as investment management and how do we go about doing it here at Compak. What makes us different? You hear so many people talking about so much stuff. What makes us different at Compak? Let me show that to you. First of all, in the investment management piece, we look at trying to find the best solution for you. Our mission statement is to enhance your life experience. Here's a little example of how.
We spend a lot of time and energy to understand the financial goals and emotional makeup of each client, and only then we develop a long-term investment plan and a financial strategy.
As a member of Compak's Investment Management Committee, I help our team select investments for our clients. Our goal is to create a mix of investments that is just right for our clients. We invest in companies that are reliable, growing, and in most cases, leaders in their respective industry. This worked for Warren Buffett, and we believe it is a prudent strategy that can deliver successful outcomes for our clients as well.
In a volatile world, investors experience exuberance during bull markets and stress during bear markets. Our clients have the peace of mind that their trusted Compak advisory team has developed an integrated solution which accounts for their emotions, risk tolerances, financial objectives, and their life goals.
Every investment portfolio we create, every meeting we have with our clients, and every program we develop is driven by our mission. That is, to enhance the life experience of our clients.
Again, that's what we're trying to do. We want to enhance your life experience and make a better life. Just having more money for the sake of more money after a certain point where you have all your basic needs, the housing and food and all of that covered, then what does money do? You have to look at what can you use it as a tool to make you happy, and that's what we try and do. This is how the investment committee is structured. There's a chief investment officer, which is me. We have a senior portfolio manager, which is my brother, who's also a professor at University of California, Irvine. And then we have some people who do research, financial modeling. And then we have research analysts. These are people who've got masters in chartered financial analysts, masters in financial engineering, and they help us make decisions as a team. It's not just one person, but it's a team that is managing your money. Looking at the risk management, I look at technicals. We look at the valuations. We look at the PE ratios, etc., and I'll talk a lot more about it. And then we also look at the economics. What is going on in the world? You have to really keep an eye. We first of all have an asset allocation. We have a mechanical model that tells us when we're risk on or when you're risk off. And then we have selection process where we find the best stocks that we can find. And then we have about 30 to 35 stocks that we like to have in our portfolios and some ETFs. And here's another one that we look at the investment large cap stocks. We look at a research. We look at about 150 stocks. We have our own screening. And then we come up with a final score on these stocks. You have to do the valuation work, look at the PE, price to book, sales, EBITDA, dividend, earnings per share growth, operating margins, return on equity. You look at the debt to equity ratio. We look at all and score these. So you can have a maximum score of 10. I like stocks that have a score of 8+. But you have to do all of this homework before you can find exactly what. Okay, I'll go to the questions in a minute. We changed the fonts need to be a little bit larger for me. So we're looking at that, and then we look at the fundamental score. That's what we need to do. You have to do all of this homework. 10 years ago, that's all people, 20 years ago, that's all people used to do. Now people have gone to this technical models and, oh, look at the technicals, and that's what they're trading. You have to do all the fundamental and the valuation work and then combine that with technical work. You've heard me say that for the last 15 years. That's what you have to do. Then we have a portfolio. You look at the transition process, and we look at existing investments, and we bring them over. But before you do any of this, what you have to understand is, what is your risk number? You can have the best laid plan out there, models out there in the allocation. As soon as volatility hits you, say, oh, I'm out. And then you get out Monday morning, and here Wednesday, 3 days later, market takes off, you're out. Then you go, oh my God, I can't get in because the market is higher. You wait for a year or two, then it's a lot higher. Then you never get in. Finally you get in, it comes back down again, you get out again. What you have is the wrong risk in your portfolio. You can have the best economic and modeling done, but if you don't have the right emotional number, as soon as that, it's out of balance. First of all, you need to find out, what is your emotional risk appetite? And that is where we ask you questions, and that's where we do. First thing we do is we find your risk number. Then we have a portfolio. If you have a risk of, you're very risk averse, you need dividends, you need income from your portfolio, and you have risk number 39, you can get a 40% stocks and 60% bond portfolio. If you have risk number 40-60, risk number 49, ended up with that. If you want growth and income. If you're not retired and you're young and you want growth in your portfolios, then we have a different risk number and a different type of portfolio. So what we do is we find the right risk number for you, and then we find the right financial number for you. We match the two up and make sure that you can handle the volatility. That's really what you have to figure out. Cash is 1 and Tesla is 99, and your risk will be somewhere in the middle. And maybe it's a 75. That's the S&P risk. Maybe you're a 60. So you might have a dividend income portfolio of 80-20. Or if you have a growth portfolio, risk is 63, you might have a growth portfolio of 80-20, where you have 80% growth stocks and 20% bonds. Why bonds? That's the part that is the ballast. It keeps you in balance. It's like the boat. It has balance. It keeps it from tipping over when the first big wave comes. And that's what you want to have, is the right degree of balance in your portfolio that stops you from tipping over when the first shock wave of volatility hits. That's what we have to do. You have to find the risk portfolios. You might say, hey, I've got 20 years of up and down. I can handle the volatility of the S&P, and we develop that. Looking at, again, size of recovery, amount of money that we put in, 1.5 billion has gone into, went into 1.5 trillion, 2009 to, that's the first QE that the government did, quantitative easing. Everybody said, oh my God, this is going to cause inflation. It didn't. In COVID response, we did about 2.83 trillion. That's the COVID response March through July. Another 900 billion economic relief bill. Then we have the American Rescue Plan of 1.9. We already have done $5.6 trillion, 4 times as much as we did in the last financial crisis. Nearly 4 times as much. And we still have another $1 trillion in infrastructure that is going to be spent over the next 5 to 10 years. And then we don't know what's going to happen with the social infrastructure plan that President Biden is talking about, another $3.5 trillion. I don't think a lot of it is going to go through, but we'll have to wait and see if that does or not. Again, the timeline, we're looking at money going out, $600 direct payments, $300 unemployment insurance per week for unemployed, potentially another $2 trillion over a decade. I think it's down to $1 trillion now, this number. Direct payments again, we saw the second American Rescue Plan, $1,400 per person checks going out in the mail, and up to about $3,600 child credit, depending on age for 2021. That's just starting out there. So we're seeing all of this money coming in, and it's going to continue to support the market, at least in the short term. The market is floating on a tsunami of liquidity. When does this liquidity go away? How will it be absorbed into the economy? Will it cause unnecessary bubbles in the economy? We'll have to wait and see. I mean, they're talking about the real estate bubble. So many people are talking about that. And Raj has a question, what did you take on the housing market recently? Is there a possibility of a repeat housing bubble in the near future? Raj, I don't think so. The reason for that is because this time around, the banks have not gone crazy. If you try to go get a loan from a bank, they want 20%, 30% down payment. They want 800 credit score. They want you to have a good income stream. The loan standards are so tight. Plus, the people have a lot of equity in their homes. They're not getting those negative equity loans like they did in 2008 and 9. I think, yes, prices can stabilize. We can't continue to grow at 25% a year in the housing market. Obviously, it's going to slow down. But I don't see a crash coming in the real estate market. There could be certain sectors. We could see maybe commercial real estate will back off. So many people are waiting to buy commercial real estate. Again, there's so much liquidity sitting in the system. As soon as an asset comes up on the market, it is sold. I mean, try to buy a house in San Jose or Los Angeles or anywhere else. There are bidding wars everywhere. Or Scottsdale. People are not buying houses at the price that the sellers want to. They're paying more than what the seller wants to wants to pay them for. So I don't see that in the short term, Raj, in the real estate market. Interest rates, again, they have come way down. I remember here, I got my first loan. I was fortunate enough to buy a house in 1981. Yes, I did. My first home. And it was a 14% mortgage. And the builder bought it down. My kids think I was crazy getting it, but it was a great rate at that time. Since then, the rates have come all the way down from 15.4, the 10-year, to 1.45 in June. Today it's 1.2. Today it hit 1.11 or 1.2 yesterday. So we're looking at June 2021. It was negative. That's real Treasury yield. Real Treasury yield is where you take the interest that you're getting minus inflation. When you take that, you get a negative interest rates, and interest rates are still negative. That means after inflation, you're not making money. They're negative interest rates. So we still have a long way to go. Here's a technical chart, and I thought the Treasury, this is a 200-day moving average right here on the yield, on the 10-year Treasury note. Each one of these red and green lines is 1 day, and this is the 50-day moving average right here. And this was the market. The yield started to come down, and then it gapped lower on Monday. Yield comes down as bonds go up in price. When yields come down, bonds are going up. So Monday, bonds were going straight up. People are buying bonds because the stock market was down 900 points in the morning. And everybody said, oh my God, the world is ending. I better go out and buy some bonds for safety. More people buy bonds, the rates go down. The rates gap lower, leaving an island bottom right here. That's where there's this is the low on Friday, and this is the high on Monday. A gap right below the 200-day moving average, leaving what is called a 2-day island bottom. There's a space between 1 day's chart and the next day's bar, and that's called a gap. Then we went down yesterday, hitting nearly 1.112, and then we gapped up today, leaving a 2-day island bottom. Usually that's a turning point. So I think we made a short-term bottom in interest rates here, and we're going to head back out. Today we closed back above the 200-day moving average, which is a good sign for the yield. And if yields go up, that I think will be a good sign, because everybody was worried on Monday morning, oh my God, COVID is back, we're going back in a lockdown. The reopening trades or the small caps took a beating, and everybody ran back to technology. In the last couple of days, that is absolutely reversed. We're going to see a lot more of this volatility now. Look at the technical charts a little bit later on when I talk about the S&P 500. But I think rates have bottomed at least in the short term, and the fear of another lockdown is going to go away. The consumer confidence is coming straight up. It's because of the savings rate. People are feeling better. People are getting vaccinated. We're reopening. It might take another hit in the next month or so as COVID spreads a little bit, or we get isolated spikes in different areas. Same thing with the University of Michigan survey. We went up, came back down a little, but now we're going back up again. So consumer confidence out there, and that is, remember, consumers 2/3 of the U.S. economy. That's what it is. It's spending. We love to spend money in this country. Again, if you have questions, just type them in, and I will try to get to as many of those as I can, and just type them on. And the question and answer, there's a Zoom feature right there and you can type in your question. I'll try to get to as many of those as I can. Income analysis and yield. Why is the yield negative in the EU? That means European bonds are German bonds. When you loan money to the German government, you'll get less back after 10 years. So they've got a negative interest rate. Will current inflation lead to a significant rise in U.S. interest rates? Let me try and answer that question. I mean, you look at the amount of global bonds out there, they are a lot larger when you look at the whole market around the world. The bond market is a lot bigger than the stock markets of the world. We have to remember that. And that's what we're seeing. And inflation expectations have gone up a little bit, but I think as we pass this, we're going to come back down on this inflation. The Fed says they're going to raise rates somewhere in 2023. Well, I think they're going to have a meeting next week, the FOMC meeting, where they're going to set interest rates. I don't expect them to really announce any tapering decisions until August, where they have the Jackson Hole meeting, where all the heads of all the central banks from around the world, they come and meet. in Wyoming and Jackson Hole, and then they sort of make major policy changes then. That's when they might announce some changes in policy where they might take away the $120 billion in savings in bonds that they're buying every month. $40 billion is MBSs, mortgage-backed securities, and $80 billion of this is treasuries. That's what we're seeing. $40 billion mortgage-backed security, that's really keeping interest rates low in the real estate market. We can take this $40 billion away. I don't think it is going to impact the mortgage market, the real estate market, maybe slow it down a little bit. And that's where I think we are going to see a slowdown. And then we're going to see treasuries. Maybe they'll announce doing about $15 billion a month starting next year. That's what they'll start doing, at $10 to $15 billion a month, where they'll stop buying. They'll buy less bonds, 15 billion less every month. Right now, as the bonds, and then they say, well, first we're going to stop buying new bonds, and then they say, okay, we're going to do the roll-off. For a period of time, what they do is bonds mature, they replace those bonds. So that's still, they're buying bonds. And when you got 8 trillion of them, there's a lot of bonds, $8 trillion worth of bonds that you're holding. A lot of them mature, then you have to replace them. But if they, at some point, they'll say, well, we're just going to let them roll off. So as they mature, that's when they'll start bringing the balance sheet down. But that does not happen until starting in 2022 and then go through 2020, depending if how the economy does. If we get another spike of COVID, we start seeing people, the governments are not going to mandate lockdowns, but people lock themselves down because they know now what COVID can do. It's not the flu, and it's not going to go away. So people realize that this is deadly, and they will take precautions, and that could slow the economy down. If we do see a huge spike, which I don't think we will, we are going to see some isolated areas where we are going to see more COVID, but those people, I think that in those areas will quickly catch up with the vaccinations. We've seen this balance sheet expansion. This is, we're here right now, and it's continued to expand all through 2021. So the first hints I think we get in August when they're going to start tapering. That's at the Jackson Hole. And then we get a formal announcement in December how much they're going to cut back. Maybe they'll just stop buying mortgage-backed securities. And then they're going to start about $15 billion per meeting, tapering pace of meeting, all through 2023. And then they're going to take a look in the beginning of 2024 or 2023 and say, how did the tapering go? And then they might start raising rates. But there's a lot of ifs and ands, and things can happen in between here and there. I think the Fed will err on the side of caution. They're going to continue to do whatever they have to do to stimulate the economy. Mr. Jerome Powell he has to come up for nomination against in February. If he gets the president upset, the president's going to get rid of him and get another chairman of the Federal Reserve. We have elections coming up at the end of November next year. So I think raising interest rates will be very, very difficult, and no one wants to be blamed for the next recession. So if you look at the Fed, they're buying everything right now is being bought. These are Treasury net issuance, how much the Treasury is issuing, and this is what the Fed is buying. The dark blue line and the light are so every bond that is being issued now by the Treasury is being bought by the Fed. Just like in Europe, every bond that is being issued by the European governments are being bought by the European Central Bank. That's why the Greek interest rate is about half of our interest rate. So quantitative easing, keep interest rates low. Rates in the EU and Japan are negative because they're buying all the bonds. We do see a range in inflation, but I think it's going to somewhere settle around 2.5%. And the economy continues to grow. We believe the 10-year is going to be between 1.25 to 2.25. Hit 1.12 yesterday, and as I showed you the chart, I thought that was a low in rates, and we could go back up from where, which is a good sign. Yes, rates went down on Monday because people are scared that we're going to lock down again, the economy is going to go into free fall, and that's why everybody was buying bonds. I think that's not going to happen, and that's why people are going to continue to buy the stock market, and we're going to continue to grow as far as the economy is concerned, and that means interest rate should be higher. Let's talk a little bit about the Biden agenda. Will the stepped-up basis go away, or will taxes rise significantly? Again, an infrastructure deal, $1 trillion. It reduces risk of massive we have a 50-50 Senate. Manchin and Sinema are both opposed to large tax increases. And that's what Manchin is saying. And then they had made a deal on this $1 trillion with the senators. 10 senators, 10 Republicans were going to go with them. And they said no. They want all the bill in place before they do it. Probably we're going to get this $1 trillion done. But the next $3.5 trillion, I don't know, because that will need corporate tax increases. We feel there's a good chance that we're going to go from 21 to 25 on corporate taxes. Capital gains going from 25 to 27. I think it can go up, but some people are saying they could go to about 40 or 45. I think the probability is medium to low. I think this is moderate to high. Social Security taxes going up, that's low. Stepped up basis, what is that? Let me explain that to you. What stepped up basis is somebody bought a building 20 years ago for $1 million. They passed away. The kids inherited the building. It's worth $10 million today. Their cost basis is $10 million. They can sell it, pay no taxes. That's what's called a stepped up basis. The basis went up from $1 million to $10 million when they inherited it. But if the stepped up basis is taken away, then when the kid inherits the building, their base is still $1 million. If they sell it, they've got to pay tax on that $9 million. Or if you had a farm, you've had it for generations. Somebody inherits a farm that their great-grandfather started, now they've got to pay taxes on what they inherited. And that is going to be a boon for corporations. They're going to vacuum up all the great small businesses that drive America. They're going to vacuum up all the farms that drive the backbone of agriculture in this country. It's not good, but that could happen. And if that happens again, it'll be akin to what happened when we let China into WTO. All the factories moved to China, and we hollowed out our manufacturing base. If we do the same thing again, and we take away the stepped-up basis, it'll kill small businesses. That's what drives America. I don't think it'll happen. The probability, I hope it doesn't happen, is very small. Marginal tax rate going to 39. It could happen if you make over $1 million. This could happen. Let me go to some questions now and talk a little bit about it. If we do see tax increases, we expect earnings at 212. They'll take away about $10 if we hike interest rates tax rates from 21 to 25. If the corporations have to pay a minimum tax, it'll take another $5. Still, earnings are going to be great. Let's go to some questions. Says Max, any indication of future recessions? If so, what could trigger it? Max, anything can trigger a recession. It's always something out of left field, not what everybody is talking about. So I don't think I see a recession in the short term, especially with the amount of money saved on individuals' cash that individuals are sitting on, and the amount of money that is being pumped in the government. I see the next 6 months as clear sailing and no recession, unless we see a very sharp rise in COVID again and lockdown again. Probability of that is very small. Moodit wants to know why own bonds with rising rates. Bond portion of equity bond allocation do not provide portfolio protection. Our rates are already at zero. Great question, Moodit. Why do you want to have a bond? Well, first of all, you're not buying a zero coupon bond. You're buying good quality corporate bonds, and if they're giving you 3-4%, it's better than having cash. Bond is the balance of your portfolio, the amount that is not in the stock market. So if you have $10 million, you don't want $10 million in the stock market, only $5 million in the stock market, and $5 million somewhere else. Or if you've got $1 million, maybe you don't want the entire million, depending on how much risk you can handle. If you can handle losing 30-40% like people did who were in all stocks in 2020, it's okay because you could handle it. But a lot of people cannot handle a 30-40% loss on their stock portfolio. That's why you have to have the right mix, and that's why you have to have bonds. It is the ballast. It is like CDs for your portfolio. Corporate rates, I know we are here. We're not at the highest rates. We're not at the lowest, but we're here. If we go up a little bit, it's going to be okay. I don't think it'll be the end of the world. Infrastructure spending, we are way down here. Look at China, how much money they're spending on infrastructure. This is from 2018. We've got to get this way up here. And I believe, I've said this for years, if you've been listening to radio show, I said, look, if I could borrow money at zero, I would borrow a couple of $1 trillion and put it into building bullet trains and bridges and airports and new highways where we have all the roads that we need, and it'll pay off in the long term. It's something that is not wasted. It helps have broadband for everybody in the country and available for everywhere. Those are the kind of things that enhance productivity. I know we don't see a real return in the short term, but in the long term, it will pay off. Let's talk a little bit about financial planning. Again, just buying one stock and trying to get rich is not the answer. You have to have a comprehensive solution to get from where you are now to where you want to go. So many of you just spend one day, so much time just finding that one stock that's going to make you rich. It's never going to happen. You have to have a concerted, balanced portfolio. You have to have financial planning. You have to understand how much risk you have in your portfolio. You have to have the right insurances. You have to minimize taxes. That is a very, very big thing, and you have to have the best tax strategies in place. Every year, I talk today about HSA accounts. Do you have the HSA? What is it? How does it work? Do you have the Roths? When do you take your money out of your IRA, turn it into a Roth? When do you take Medicare? What kind of Social Security? When to draw Social Security? What kind of insurances? Those are all the answers that you get from a financial planner. Every one of our clients at Compak has a dedicated CFP. Not the people who are managing the money, not the people that are updating you on the portfolios, but a separate person that is just doing financial planning. And it has a decade or more of experience of doing financial planning. But they've seen hundreds upon hundreds of people in different phases of their life, retired, non-retired, young, old, professionals, and so on. And that's why we have a dedicated CFP for every account. So let's talk a little bit about financial planning, and let's meet a couple of the financial planners right now.
Financial planning is a matter of broadening our conversation from asset management to life management.
We take a different approach to financial planning. We take the time to understand not only your financials, but how you think, what is important to you, what concerns you, so your financial plan is meaningful to you, not just pages of numbers.
The financial planning department is often deemed the what-if department. What if the kids go in-state versus out-of-state university? What if we retire at 60 instead of 65? What if there's a bear market in my early years of retirement? Answering these questions and more is what drives the value I provide our clients at Compak.
One of our clients' main concern is taxes. As an IRS enrolled agent, I use my knowledge of U.S. tax laws to help our clients with tax planning to maximize their wealth.
It is the combination of smart money management and intelligent decision-making that makes a financial plan work. This leads to what is ultimately the most important thing to our clients, which is how can I help them live the life they want to live?
Yeah, that's how can we help you live the life you want to live? That's what you want to do financially, and that's what we try and do, is get you from point A to point B without taking all the detours and going down those one-way streets. You don't want to do that. So the CFP is a dedicated CFP that you get a direct phone number to your CFP. Besides having the relationship manager keeps you updated. Besides the portfolio management team that is managing your money, besides the account executive that handles all your paperwork in the back office. So you don't have one person, you have a team that works with you. And they set realistic financial goals, we look at budgeting, identify your risks, and look at everything that needs to be done. Look at your cash flow, investment planning, risk management, tax planning, retirement planning, estate planning. You have to have all of these things. If you're thinking you can just buy one stock and get from point A to point B, not going to happen. I hate to disappoint you. It's not going to happen. You have to have all of these to get from point A to point B. And that's what the Certified Financial Planning Division does. No extra cost, no limited time. They spend all the time that is necessary to make sure you get the correct financial plan. And they sort of work with your CPAs, they work with your accountants, your attorneys, your business advisor, your real estate agents. They give you all of that. They'll look at tax planning analysis. We look at the next 20, 30 years of your taxes, see when you're going to come down and go from there. And again, we do what if analysis. This is a Monte Carlo, which sort of lives your life 150 times, how long you're going to live, and lives the market conditions, 150 different market conditions. Marries the two and gives you a probability. Are you going to outlive your money, or the money is going to outlive you? You want to make sure that the money outlives you. Again, if you have questions, type them in, and I'll be more than happy to answer as many of those as I can. Bubble with long-term implications. Let's talk about crypto. Well, there's about 5,000 cryptocurrencies out there. Yep, that's in tokens. China's already clamped down. You heard me talk about regulation is the biggest threat, because countries don't like to lose control over their money. That's what they do not like to do. So you want to make sure that they can control the money. And I think, again, the question, people say, well, will the dollar, will crypto replace the dollar? And Raj is just asking a question, will the dollar retain its popularity in the face of growing trend of digital currency, Bitcoin, etc.? Well, if you had Bitcoin, it was worth 60,000 a few months ago, Raj, and now it's worth 30,000. That's not good. You don't want your money to be worth half as much as what it was a few months ago. The volatility is very, very tough. You don't know which ones of these 5,000 currencies is going to be open. And when the government comes in and says, hey, you can't have a Bitcoin because we've got the digital dollar. We would like to have the Chinese yuan. What they want to know is where the money is being spent. If you have the Chinese yuan, you can have it on your phone. You go and give it to the merchant takes your phone, and it goes directly from your phone into their account. But in the meantime, the government knows exactly who's got how many digital yuan. Same thing, the digital dollar. Government wants to control their currency. Crypto is something that they cannot control. So sooner or later, you're going to get government regulation that is going to say, hey, we want to know where this money is, where you got it from, where you're spending it, like they do right now. That's why I think crypto is going to be a problem. Some of these cryptos will survive in the long term. Next 10 years, we are going to see digital national currencies. That's where we are going to go, rather than these other cryptocurrencies. And the crypto risk is traditional financial firms have risk, and central banks control of monetary policy. Whenever you have a dollar, it's deposited somewhere, either at a bank, at an institution, or at a brokerage from somewhere. Crypto is kept where? Nowhere. It's in the cloud. That is why it is not, it's the intermediaries that are going to be a problem. They have to figure out exactly how this digital world is going to go with digital currencies, and how the governments are going to control the digital currencies. You look at volatility, you can see that this Ether was down, Ethereum is at 1.90%. Bitcoin volatility is about 75% compared to the US dollar. You want something that's stable. That's what you want. And the one that I'm really worried about is this one, Tether. It is originally, it's a stable coins, aiming to be fully backed by a currency, by the dollar or whatever. It was found that each Tether was only backed, they had 2.9% of this out of the 58 billion was backed. Rest of it was nothing. They said, no, this is convertible. You can convert this to a dollar at any time. But they only had 2.9% of real assets. That's the thing that worries me about a lot of these tokens, currencies, whatever you kind of want to call them. What are they backed by? Looking at, so crypto I think is something. Yes, in the long term it's going to work, but the short term I don't know. It's like the dot-coms. You don't know which ones are going to be good, which ones are going to be bad. Yeah, there will be the Microsofts and the Googles and the Facebooks that are going to come out of it. And if you see those coming out, you buy them and you stay with them for a period of time. Reopening status, well, we are looking at another small mini wave of Delta virus that is hitting Britain right now. And we are about 2 to 3 weeks behind Britain and Europe. That's what has been the case. I talked about it last year when we saw the initial waves in Europe. And that's going to come here too. And it is, it is the virus of the unvaccinated. That's really what it is. 97.5% of the people that are hospitalized are unvaccinated. 99% of the people that are dying are unvaccinated. So it's the virus of the unvaccinated, and that is a choice that people have made. I think we are going to see a lot more people get to the vaccination stage once they see another surge of the virus. I hope they do, put it this way. The Delta variant, now we've got another one called the Lambda variant, which is another one that people are starting to talk about. We don't know what that is and where it's coming from. But the Delta variant is much more infectious. That's what we're looking at. When you look at the confirmed cases, they've come way down. You look at fatalities, they've come way down. And I think, again, to get to herd immunity, it'll take another maybe a couple of months for us to get there. Reopening, if you look at we are 2 million right now TSA checkpoints last year. 2019, we were at 2.6 million. So we're still about 21% lower. But if you look at weekly retail sales, they are higher than where they were in 2019. You look at box office, yep, it's down. But you look at rail car traffic, it is higher. So we have come back in a number of areas. Steel production is just about back up. We're looking at restaurants, 6-8% down. We are getting there. We are definitely starting to travel again. Gasoline usage is going up. That's what we're seeing right now. Commercial flights, global, yeah, that's because countries have not vaccinated. So we are not seeing those global flights yet, but we are going to get there. Vaccination rates, again, China is winning the vaccination battle, but they've got Sinovac, that's what they call it, I guess. And the efficacy rate is 3% after the first shot, and I think it's 30% after the second. So it's really not very good. We are using much better vaccines. Germany is catching up with us, France also. UK is way ahead of us right now, but they are reopening with a new surge. So it's going to be interesting to see what happens. This surge gets worse? It's sort of like an experiment that they're doing with the vaccination rate very high and the reopening with a high infection rate right now. So it's going to be very interesting to see what happens in the UK over the next couple of months. Confirmed new cases, you can see that India hit the surge, but the surge has subsided. United Kingdom, they had the surge, it came down. Now they're seeing another surge. We'll see how this plays out over the next few weeks. Delta variant is driving a rising proportion of new cases. You look at it, it's about somewhere around 90% of the United Kingdom cases are coming out of Delta. It's the Delta variant. And it's going to increase in all the other countries too, so we'll see how it plays. Wave, again, we saw this wave peak out and then it came down, but now you can see that it is, daily cases are going up, daily deaths are not there, hospitalizations are starting to go up. This is in the United Kingdom. Will that follow here? I think so. But again, this is, now it's a choice of people. So we'll see how this plays out over the next couple of weeks. I think it's going to cause some anxiety in the market like we saw on Monday. It's going to create volatility. We're going to go up and down, and be prepared. August and September are usually volatile months. But if you have the right balance, you have the right risk number in your portfolio, it's going to be okay. If you want us to take a look for a risk number for you, just give us a call. We'll do the evaluation for you. There's no cost. Lily has a question. Hi, Mo. Your guest speaker said avoid multinational companies and overweight in domestic stocks. However, the value is in emerging markets. How are these two different issues? Any conflict? Well, I have a lot of different guests, Lily, and some I agree with, some I don't, but I like to have a lot of different opinions on my show, and that's what I like to do. I've increased my international and emerging markets. I'll show you some charts. I think we went through the reopening, trade losing a lot on Monday. It's come right back up. I think this is a great opportunity to add. By the time it becomes obvious, it's history as far as the markets are concerned. So as this recovery ricochets around the world, as they get the vaccines, they are going to reopen also. That's why I think they're 3 to 6 months behind us, but the market moves in anticipation. Once we know the fact, it will already be gone. So that's why I would start looking at having the right mix. Now, don't put all your money there, but you should definitely look to increase. As I showed you that chart earlier, the world index is about 27% undervalued compared to the S&P. It's the lowest level we've seen in about 13, 14 years compared to the S&P. So you buy undervalued assets, over a period of time, everything reverts to the mean. It comes back, and that's what happens. The Delta wave in the UK, new cases, hospitalization rates, percentage 1 week lag. In England, death rate given hospitalization percentage, you can see that it was here, now we're here, but it's starting to come back up. That's what worries me about it. Again, original virus, this is the measles, this is Delta. We have vaccinations for measles, we have vaccination for mumps. We do have a vaccination for Delta also, but it is 4 to 5 times much more contagious. Public health in England showed that Pfizer and BioNTech vaccines 33% after 1 dose, 88% after a second dose. AstraZeneca 33% and only 60% against the Delta. So if you have Pfizer, you have the mRNA as it's called, that's a new kind of vaccine. That's the Moderna and the Pfizer, you'll be okay. Look at the states that are most vaccinated are here, Northeast, least vaccinated down here, and those are the least. Again, second most is the West Coast. Again, it's unfortunately become a political issue. But unfortunately, politically, this is not good. You don't want to kill your own voters. That's what you don't want to do. I don't know why people are telling their voters not to get vaccinated. You want to get as many people out there to the polls as you can. You're looking at holding Olympics. Nobody wants to have the Olympics right now. It's going to start this week. It's going to be fun. But without anybody cheering these athletes, it's going to be very, very difficult. And the amount of COVID that's going to spread. They're already having problems with it. So we will see how, but it's always these people have spent their lives preparing for this one moment. And they should have their moment. I mean, that's the way I look at it. But it's a dangerous proposition. But they've spent their lives, and they only get a certain chance because after they've hit their peak right as they at certain ages, and after that it's very difficult. So I hope they have a great Olympics. I hope it's going to be great. So we'll be all watching and see what happens. Here's one from some more questions here. One from Johan. He says, Mo, will this be available for a replay? Will you put it on YouTube and make sure you're good? Yes, you can. I will put it there, and you can go to compak.com /YouTube. I'll put it there. I will make sure that it gets there. So I know it's a lot of charts and a lot of information, but you can absorb it taking your time. 5-day original work week or hybrid. Well, we have a meeting a Zoom meeting every morning, and we've done that for last year. Efficiency rates have gone up in the last year, which has been great, even though we're not in the office. So about a couple of months ago, I said, great, let's go back to the office. All of a sudden on Zoom, everybody went quiet. So wait a minute. I said, okay, let's get back to the office 1 day a week. Then you heard this murmur, okay. I think it's going to be gradual. We're going to do 2 days a week in the office, 3 days people are going to work from home. But different companies have different financially. We financial firms can do this. Other firms can't because you have to face them. So I think we're not going to ever go back to, I believe, a 5-day work week. Certain companies will have to, but people who don't have to will have some kind of hybrid. You look at the people year over year, e-commerce share, it has grown 4.5 times of where we were. The average growth was 1.3 for 2015 to 19. In 2020, it was 5.7 times, 4.5 times, 1.6 times in China. That's for the UK. This is China. United States, 3.3 times. It's just astronomical growth. We've sort of brought the digitization of the world, we've accelerated it. And once you let the genie out of the bag, it's not going out of the bottle, it's not going back in. That's once you get used to Prime, you have it delivered the next day. Why have to go to the store? So that's what we're going to see. A lot of jobs are going to go away. There'll be mix of occupation shift by 2020. You can see that 2030. You can see that consumer sales, food service, agriculture, all these jobs are going to go away. And it's not just here, United States, Spain. You look at all these countries, and then all of these countries are going to have more use of these kind of workers. So there's certain areas that we're going to see more people, certain areas that they're going to change jobs. 17 million people are going to transition post-COVID, job transition post-COVID scenario. 17 million people are not going to go back 17.1 to the same job they had previously in the United States. So it's going to be a big change. The world is going through a big change. And we have to be prepared for it, not get stuck in the past. Let's go and take a look at the charts. One of the things I want to talk about today, I'm going to show you a different kind of chart, a 60-minute chart today. Going back, each one of these little red lines, green lines and red lines is 60-minute of trading. That's what it is. And you see a fifth wave top, then you see an A, B, C correction. This was down on Monday, and since then we've come back. We have a target here of about 4,400. Well, that's the target I put out. Why do I think we can get above 4,400 now? I think we can get to short-term 4,435. Look at this. This is how oversold we were, and this was in May. This is where we were oversold right here. And we were just as oversold. We haven't been this oversold since then, and we were here. This is the moving average convergence divergence, or a MACD study, as I call it, MACD study, and it is on a 60-minute chart, looking back a couple of months. But it shows that we should get above this 44 high and get up to the target for the fifth wave is 44.35. Short term on the daily charts, I've had this chart out. This is where each bar, green and red, this red and green line, vertical line, is 1 day of trading. It goes back to about August of last year, about a 1-year chart. And this is as of today. I put out this target of 4,400. Well, we had that at the beginning of the year. Well, we hit 43.93 last week. We're today closed at 43.58. So we are there at about 44. We might nick it a little bit, get to 44.35, as I mentioned on the hourly charts. But we need to. We've gone straight up. I mean, look at this chart. We've been going straight up. We have seen little dips, very tiny, nothing serious at all. So overall, the trend is nicely up, and the trend is your friend. You want to be in the market and enjoy it. Short term, I'm looking at this. This is a 50-day moving average, which is 42.35. That is, we kissed it on Monday and took off from it on the upside. Here's the next chart. Each one is one vertical bar is 1 week of trading. This goes back to 2018 and 2019, 2020, this is March of 2020, and this was the bottom in March of 2020, and this is 2021. You can see support is at 42.50, 4,000, all the way down to 34.40. Again, third wave extension. Everything moves in 5 waves. This is wave 3, wave 4 down, wave 5 to the upside. That was the top in March of last year. Then we see an ABC correction all the way down. Then we start a new wave count to the upside. 1, 2, and we're in the third wave right now. Somewhere we are going to get a fourth wave pullback. Either we get it now in the next couple of months, or we might continue going up straight to 44.75 to 44.35, and the long-term target is 46.50. Will we get there by the end of this year, next year? We'll have to wait and see. Once we get to a fifth wave on the weeklies, then we have to sort of worry about a much deeper pullback, or maybe even a bear market. Might not get there until next year or year after. Nasdaq, same thing. My target was 14,750. We got close to it, 14.8. Backed off from there. 50-day moving average is 14,000. That's the support area. Target on the dailies is 16,000 for the Nasdaq. Again, these are my opinions, the way I'm looking at the charts right now. 200-day moving average is 13,168. This is wave again. But on the dailies, we're seeing wave 5. You saw that on the dailies also, wave 5 on the S&P going backwards. So we could see some back-end filling, and that's why once you see a fifth wave top, on the dailies, you could see some, and that's why I'm looking for some kind of deeper correction. I know Monday we were down. Well, one day does not make a pullback or a correction. It has to be prolonged. We have to get all the people, the cryptos and the meme stocks wiped out, and that gives us a nice opportunity to get into these markets at some nice levels. That's what we have to get, the froth out of the market. This is the daily, weekly chart, where again it's 1 week of trading. Each one of these bars, wave 1, wave 2, wave 3, and we could see a fourth wave down. If we come down to the fourth wave, that's about 13,000. We're at 14.6 today on the close, so pullback could take us 13 or 14,000 as a 20-week moving average. This is the 50-week. Fourth wave target also comes in somewhere around there, around 13,000. Are we going to go up first before we come down? Trying to figure out corrections is just a waste of time. Gold, very disappointing. We saw interest rates come down. That usually is a propellant for the gold market. But interest rates hit 1.12 yesterday, and the gold market didn't do anything. It hit the 50. This is the 200-day moving average at 1826. It hit it and fell right back down. Now interest rates are starting to go back up. Interest rates go up, that's going to be negative for gold. We need to get above 1826. If we do, we could see gold get to 1960. But as you know, I haven't been a big fan of the gold market for a couple of years. Emerging markets. Lily had asked me a question about emerging markets. We came down to the 200-day. We hit it 2 days in a row. Today we popped up. If we can gap higher, leave an island bottom, I think that would be a sign that we're making a bottom, short-term bottom, and could be headed back up. Resistance is the 50-day, which is around 54.3 on the EEM. That's the emerging market ETF. Again, third wave top, fourth wave pullback. Fourth waves are messy. We're in the fourth wave, and then we should start a fifth wave to the upside. Same thing, Russell, small caps stuck in a range. 2100 on the downside, and 2360 on the top side. Just keep bouncing, just going back and forth and back and forth and back and forth. And it's been going like this since what, September? Beginning of the year. We hit the top part end of last month. Everybody is excited. Then we came all the way down, nearly hit the 200-day moving average, which is 2088. We are at 2100. Looks like we're headed back up. This is reopening. This is small cap. Everybody was excited about reopening. Small caps are small companies. Then everybody said, oh my God, now we had the Delta virus. That's what's scary. So once we break out above 2360, that will indicate to me that we're firmly in reopening. COVID is history. You know, however we did it, and we break out. Once we break out above 2360, next target is 2495, about 2500 on the daily charts. So the Russell this is small cap, just gone stuck for the last 6 months, going nowhere. Same thing if you look at a weekly chart. Each one of these vertical lines, green and red lines, is 1 week of trading. Going back to 2017, you can see this was last year's decline. And since then we went straight up, anticipation, once we saw the vaccine coming, but since then stuck here. Need to get above it, 24.25. Long-term target is 28.50. So again, emerging markets, small caps, that all depends on the reopening. As we get more people vaccinated, but between next couple of months could be shaky as we get more different variants. And if we get Delta entrenched, then remember, how do we get variants? When more and more people get infected. Once people get infected, that's how it mutates. And that's what is called a variant. If we have a lot of people that are infected, then we can get more mutations or variant. And the virus might find a way around the vaccines if we get more and more people unvaccinated who are getting infected. So that's something that we have to worry about. Think we're going to go from worry to fear to, oh my God, we're closing again, we're reopening. And that could be what could happen. So this brings me to the conclusion. I think risk of inflation, I think the pent-up demand is causing that right now. Bottlenecks are going to be resolved. Additional savings spent over the next 6 months, it'll be gone. And I think that'll abate inflation, and inflation retreats. So No 70s style inflation. I'm not expecting that, at least in the short term. Debt and deficits, the dollar is the reserve currency of the world. Still, would you have dollars or Chinese yuan or any other currency in the world? Everybody still wants the almighty buck. That's how it is. It could change, but until it changes, don't anticipate a change. That's one of the biggest mistakes people make. They anticipate things can happen, and they build up this scenario in this mind. One thing doesn't happen, the whole scenario collapses. Unfortunately, the portfolio collapses with it. What you want to do is have a solid foundation. Only do the things once they become obvious. You won't get in at the bottom, that's fine, but at least you'll go with the trend. So in the short to medium term, dollar is not expected to have any issues in borrowing. At least we don't think so. There's still a lot more demand for U.S. bonds than there are bonds out there. Stock market, high valuations. Yes, PEs are high right now. Tech sector outperformance. We saw value outperform tech. Then we saw tech starting to pick up again. We still think that value is going to continue to go higher. We think, again, global markets are undervalued compared to the S&P. Massive liquidity is still flowing into the equities and real estate. Risk of corrections during the fourth quarter. Going into 2022, I think it gets higher. That's when we'll see a lot more volatility. But right now, I think we're going to get a little bit of a correction maybe over the next 2 months or so, August and September. After that, I'm looking for a great last quarter of the year. Conclusion, fixed analysis. Interest rates are negative because all the European bonds are being bought by the European Central Bank. Will inflation lead to significant interest rate increases? We think interest rates will remain somewhere between 1.25 to 2.25. That's what we expect to see. As far as the tax, there's a chance that massive tax hikes have declined, especially with the 50-50 Senate and Manchin and Sinema holding the line. I think they'll twist their arms and try to get the $3.5 trillion through the budget resolution process. They might get some part of it done, but I don't see a massive $3.5 trillion package going through with massive tax increases. I just don't see the probability of that. Cryptos, well, they're cryptos long-term. Most of them are going to be worthless. Few are going to survive the long-term value. Central banks are going to launch their own digital currencies and wipe out the cryptos in the long term. Post-pandemic world, social and economic changes, most business may introduce. Hybrid work economy will become more efficient. Traffic will get better. Believe it or not, I was on the 405 in Los Angeles going to LA from Orange County, and it was nice, easy traffic, which is great. Hopefully that'll continue. We'll adopt more of technology adoption. And don't forget, I'm going to be in San Jose next week. If you want to come and meet with me, this is your opportunity. I'm going to be in Scottsdale right after. I go straight from San Jose to Scottsdale. I'll be there on the 4th and the 5th. If you want to come and meet, go to compak.com or contact your relationship manager, and I will sit down with you. We'll develop a plan for you and get you from where you are now to where you want to go financially. That's what we want to do. Thank you so much for spending this time with me. You're listening, you've been tuned in to the Market Wrap webinar. Again, tune into the broadcast every day. You can tune in, get the app and download it, and you'll get the daily broadcast, the 1 hour broadcast that I do every day. So those are things that you want to do. If you want to come to learn a lot more. That's what I try and tell you to do, is learn a lot more, and that gives you a lot better understanding. The more information you have, the better decisions you can make. That's what you have to do. Again, thank you so much. Have a wonderful evening. Talk to you tomorrow.
This presentation contains the current views and opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.